Okay, let's take a look at the first one, prepaid expenses. So this is reviewing Chapter 2 a little. Chapter 2, I mentioned this category, it's under the asset account, remember? Prepaid expenses is not a type of expense, it's a type of asset. We prepay the rent for 6 months, and we have the right to use the location for 6 months. So this payment is made in advance. This is considered a benefit that business can actually use for the next 6 months, next half a year. So it's not a type of expense, it's an advance payment of expenses. It's considered assets. Okay, now the reason why this falls under one of the categories of adjusting entry is because, for example, earlier prepaid, perhaps a portion of that has readily expired. So if we prepaid rent for 6 months, January 1st, when it reaches January 31st, then a month of rent has already been used up, has expired. It's no longer a part of asset. It turns into rent expense. Okay, the idea of supplies is also falls under this category. So you purchased $1,000 worth of supplies. After a month, you used up, let's say, half amount of it. You have only $500 of supplies left, and you will have supplies here, and that turns into supplies expense. Okay, what we're trying to do here is that earlier, in the middle of the transactions, you might have some of the purchases that you made earlier. You purchased supplies, or you have prepaid rent. When it reaches the end of the month, when you're doing financial statements, some of those entries needs to be tweaked a little, need to be adjusted a little to match with the current status. Okay, so we're just trying to adjust some of the transactions that happened before, just make it match with the current status of the business. So if you have prepaid 3 months of rent, and now you used up a month already, you only have 2 months in force, then you want to turn that month into rent expense. If you purchase supplies that should have lasted for an entire year, after a month you go back to reevaluate the value of supplies that you still have on hand. The portion that you used up turns into supplies expense. Okay, so let's take a look at an example here. Now, what does this transaction tell us? So May 1st, we have cash inflow or cash outflow. We have cash outflow for the purpose of getting benefits of using a certain location for how long? For 3 months, right? So you see the bracket there, 1,000 times 3, and at the end it says paid rent in advance. So let's assume that this $1,000, this $3,000 is worth of using a certain location for 3 months. So meaning each and every month the rent expense is $1,000. So this is May 1st when we actually make the payment in advance, prepaid rent. So prepaid rent is an asset category, that's why we debit it. Cash we're using up, so we credit cash. Now, after a month, when it reaches May 31st, we want to adjust this account because the 3 months of rent that we paid in advance, now we only have 2 months left. Right? There's only 2 months of this payment that is still in force. So if the company is doing monthly statement, when it reaches May 31st, this will be the adjusting transactions that they will be making. Okay, so that rent, prepaid rent, will be credited because this type of asset, a portion has been used up and it turns into rent expense. So meaning when you look at financial statements, when you look at prepaid rent account, you will only see $2,000 there at the end of May because that only represents the next 2 months of rent benefit that the company has. It represents June, represents July. Then under income statement, you will see rent expense $1,000, which represents the money, the rent benefit that they have used up within this month. Okay, so if the company do not record this transaction, if they haven't recorded this transaction, then it would seem like they still have prepaid rents that will last for the next 3 months, for June, July, and August. And if that's not the case, then this transaction has to be made. Okay, so the previous entry, May 1st, would already be captured somewhere here in the middle of the month. Okay, at the end, what we want to do is this entry, this adjusting entry here. Just turn a portion of that has readily expired, that's no longer in force, turn that into expense. So here we're reducing asset, increasing expense. Okay, so this example here can also work for insurance. The company may be prepaying a certain type of insurance for 3 months. So May 1st, that transaction again will be captured somewhere here in the journal and ledger. When it reaches the end of the month, when we're trying to get to monthly financial statements, before that, we want to do an adjusting entry here, turn prepaid insurance into insurance expense for $1,000. Okay, this can also work for supplies. You may be purchasing supplies, $3,000, using up cash. At the end of the month, we go back to reevaluate what's the supplies value that we currently have on hand, turn the portion that disappeared into supplies expense, reduce supplies. Okay, so this same entry, the concept can be used for different types of prepayments. Now in the middle, you'll see a prepaid rentee account there. After we do this transaction, what would happen to that T account? Would it still look like that? What would happen? What would it look like then? First of all, prepaid rents, again, is an asset account. Asset rule would be debit increase, credit decrease, right? So earlier when we prepaid this rent benefit, we have an increase $3,000 here. After this journal transaction, we actually used up a portion of that, turned into expense. So this asset account will be reduced by $1,000. Then what? Their normal balance will become $2,000, and we'll be posting it under the debit side, the side where there's a plus sign. Okay, so this you would see after the adjusting entries. You see this T account be updated by this into this 2,000 balance instead of 3,000. Okay, this here represents 3 months of rent. After a month, we don't have $3,000 in force anymore. We only have $2,000 left for June and July. Okay, so under balance sheet at the end, when you see under the balance sheet, the left-hand side assets, you see $2,000 listed here instead of $3,000. Okay, so this is an adjusting entry for prepayments, turning assets into expense, the part that expires.